Welcome back to Your Finance TV, kicking off your work week. We have an earnings focus for you this week. And the names we're going to be digging deeper on are Tesla, Netflix, Goldman Sachs, Taiwan Semi, and Bank Oz. And Love It Like It Leave It continues that earnings theme with Bank of America, Interactive Brokers, ASML, IBM, Alcoa, and American Express. To kick off the week, we have Brendan McCarty back from Column E. How are you, Brendan? How was your weekend?
It was busy as always. How about yours?
It was good. If yours was busy, you were at Coachella then, right?
And no, I was on a sideline watching sports.
Oh, okay. Sorry. I just imagine you're a Coachella fan. All right. Before we kick off, don't forget to click on that subscribe button and like button below. Numbers continue to grow each week, and we're here to help you out and look into any sort of information or questions you want to ask on these names. Housing starts, building numbers, retail numbers, unemployment data, and PMI data is what is proving to be a heavy data week for investors this week. And don't forget, Tuesday is tax day as well for most of the states. But as I said, we're digging into the earnings. And the first name we're going to look at is Tesla. They report Wednesday after market. And looking at the chart, it looks like this stock needs to break out one way or another. We've discussed the correlation between Bitcoin and Tesla share price, but it hasn't moved with the Bitcoin rally that we've seen in the last few weeks. Is this on the back of Elon cutting car prices? Are investors worried about Elon not having enough focus right now, as there are more headlines on Twitter than Tesla? Consensus EPS is 85 cents per share and revenues of 23.7 billion. Short interest is 5.5% lower than its last earnings release. Brendan, could these numbers be the catalyst for the share price to break out, or do we continue to see a power outage for their shares? Like
I like
that?
the last line. That's a good one. I didn't think of that until now. Yeah, I think it's interesting. So the two have split, Bitcoin and Tesla. They split apart from each other. But this also happened 2 years ago at this time, and I wondered if there's some sort of relationship there, like in terms of sales and technology or weather, and couldn't figure it out. But the gap is widening like then. However, the gap is not as wide as it was back then. Back then, Bitcoin rose all the way up to 66,000, and Tesla was sitting 390, 300, somewhere in that range. 290 and 190 when it fell. This time around, the drop is not as dramatic, and BTC is only at 30K. So they have split, but I think that not by a lot. So that's one thing. Now, another thing that's not influenced here. So back then, Tesla fell from 290 to 190. This time, it's not. It's less. I think the shorts are so battered and beaten this time around. Nobody wants to short any stocks right now because it hurts too much. It's just I'd be so much. I'm very interested to see what returns are for shorts in this past quarter and coming up. So that's probably factoring into why Tesla hasn't fallen as much. So what's the story here? Elon does have his focus in many places. AI was the latest thing over the weekend, where he's going to create a competitor to all their other AIs. Can you imagine AI driving your car for you? Maybe that's the whole point of the self-driving cars is AI. But the two of us have mentioned many times in the past, the threats to Tesla have been competition. They're all coming into it, Ford, Volvo, everybody. Slackening demand. Well, the pace couldn't stay the same. We all knew that. Tesla was the only car on the road, it seemed, during the pandemic because they were the only ones producing them. And there was a lack of new products. That's what a lot of the consensus says. But if you look at Apple, I don't think the iPhone has been a one-hit wonder in a way. So I'm guessing that the lack of new products on the Tesla side is a bad myth. Now the falling prices is the big deal. He's falling. I think it's kind of interesting what Elon's doing. I'm not a big Elon fan, but he's dropping prices so aggressively that it's forcing all these other automakers who can't make that much money on these cars to respond, and they can't. So if he keeps dropping his prices, do you go pay for the F-150 that's 80,000, or do you go buy the other one that's 40? Buy his car for 46? So it's not a great play to keep dropping prices in an inflationary environment where prices are constantly rising and your margins are shrinking. But I think that Elon is making a play here. He's sacrificing the short term to really hammer away at the business, the industry. Now maybe he's confused and he's doing other things. He forgot he's lowering prices. I don't know, but lowering prices in this environment isn't the best thing. It's only a goal if you're trying to drive out the competition. And like, look at Rivian. That suffered a lot. There's a bunch of cars have come and gone. In China, I believe prices are falling for cars too. So this is also a response there. I'm guessing that with the stock price holding the way it is, the story won't be as bad as people are fearing. Let's put it that way. And I think they might actually, I mean, they surprise a little bit. The chart is in no man's land though at the same time. So the response, what comes out of this report, could dictate the way the stock works for the next three months. And it's sitting right on the 20-week, right below it, the range resistance above. A breakout above it argues that they probably had good earnings. The breakout below argues Elon probably said something that offended everybody. So it's probably, it's a very key report for the next move in the stock.
Yeah, we do a show with Rob Roy on Fridays after the close, and Tesla's been a very popular name over the last few weeks, and how it's like the flag formation and how it's just getting into that point where it's going to break out one way or another. And these numbers are definitely going to be the catalyst for that.
Yeah, I agree. It's a big report, and it's going to track them. Bitcoin and Tesla crisscrossed about 4 months ago, and they always crisscross. So either Bitcoin is going to fall back or Tesla's going to catch up. And I think if the earnings are good, and it shows, like, the guy's got a ton of technologies, and there's a lot of investors who have made a lot of money on Tesla the last several years. They're going to stick with the stock. If the news is any but good, they're going to ride this thing.
All right, well, let's move on to Netflix. And they report Tuesday after the close. The shares are up 15% year to date, but it has been a bumpy ride for investors. We know it's all about subscriber numbers, and while Netflix is one of my favorite streaming services, I am a little worried going to these earnings. Tightening purse strings and recession fears are factors that concern me, not only for this earnings release, but going ahead. Option traders are pricing in an 8.8% move on the back of these earnings, but it averages a 14% move in recent quarters after their earnings. But should investors be sharing my concerns?
So contrary to your, you like Netflix, I've never liked Netflix. And I simply believe they spend too much. They're not diversified enough. They don't have a sports platform. I know they're getting into gaming, but they're kind of late to the party on that. They do have a lot of interesting product. I did come across their latest product shows coming out, and I'm a big John Mulaney fan, so he's coming with a show, believe it or not. I was like, ooh, maybe I'll watch that. With all that negativity out of the way, Netflix is a big, my house, everybody watches Netflix except me. So I guess I'm negative Nancy. Is that the right word? I don't know. Anyway, streaming is under transition in general, though. And like, you're seeing it with Paramount merging their 2 units. You're seeing with HBO merging Discovery, I think it is, into Max. Is that what they're creating?
Well, they're renaming it, right? It's called HBO Max now.
They're
going to be rebranding it.
Yeah. So typically speaking, like, HBO's products was great when it first. I'm an HBO Max fan. I like that stuff. I like their channel, but their product hasn't been great the last several months, which is kind of interesting. I know they're launching new stuff. Netflix constantly launches new stuff, which helps Netflix compete against these other ones. Paramount, though, has figured out, let's also leverage our existing inventory of CBS product and start, promoting that as well. So the streaming wars are fully underway. Disney is talked about, should we be holding ESPN or should we not be holding ESPN? And I think streaming, its upward trajectory is in a downward consolidation mode. Netflix had a great quarter last quarter. However, this quarter, typically speaking, is a weak one for them. And consensus is actually thinking better than previous, like, breaking trends, so to speak. They're calling it the ad gains on the ad, the paid product that you can pay for them. So I still believe people are moving down from the paid to the ad stream. I mean, if you like the show so much, you're going to pay for the ad one, right? But would you sign up? If you sign up for a streaming network, do you sign up for ads? No, not typically. So I'm still so skeptical on Netflix. And to boot, Netflix hasn't moved in 5 years. It literally is at the same price as it was 5 years ago. So is that really a growth stock? Not necessarily. there's another interesting thing coming on there is the password sharing. They're cracking down on it.
Yeah.
So if there's a lot of free people watching the thing, that you want to crack down on that. You don't want to. It's called. I mean, you want people paying for your product. Well, what if the free share was driving future sales, and now you crack down on that? Well, now those people have no longer have access, and maybe they don't subscribe, and then your product is not exciting. Now, with that said, the stock does look better. It's been holding above the 65 week. It's get over 320. I just think the consensus is a little too optimistic on subs. And if that the last 2 quarters, first quarter has been rough for them. 2020 doesn't count because we're all locked down watching Netflix. So you really can't use that one as a proxy. But the last two have been weaker than consensus in terms of this time of year. So I'm guessing that I'm thinking that that's still in play, and I just don't think it's a smooth sail for these guys. I know that they spend a lot of money on great programming, and that impacts their cash flow, and they're getting away with it forever. It's like Amazon; they just kept using cash flow for years and years and years. Then they finally became a powerhouse. I don't know Netflix will be that way, but they got a lot of competition. But the stock looks optimistic going into the earnings. So investors look like they think they're going to beat, but this is seasonally a weak time. So it should be a very interesting report.
Yeah. To go back onto your advertising side of it, like to go to the free version now, you don't know if people have been using other people's passwords, but advertising revenues, and I have the premium offering, so I haven't seen it, but if you've got those numbers of people viewing it, particular shows and so forth, you can charge a premium for. Maybe that difference is being made up in advertisers paying for their spots.
It's possible.
Even
yeah.
a bigger.
I mean, I go back to YouTube. So YouTube's advertising went down last quarter, and I think YouTube is popular, if not the same popularity, if I'm not mistaken. Different clientele. I mean, it's kids more on YouTube than in the influencers. But if advertising spend is down there, how can Netflix avoid that? I don't know.
Well, it's a
like,
new
I'll look at it
product
this
for
way.
Netflix,
I'll tell
right?
you this. Oh, what? Go ahead.
It's a new product for Netflix, so they can't really
Yeah.
like go back on it. It's like it's just new additional revenue.
No, I know. But it's stealing from. So, like, where they charge $10 for the ad tier, or $6 for the ad tier, $7. They charge 18 or 19 for the full tier, the non-ad tier, which is where everybody's gone. By the way, HBO's gone there. Paramount is going there. Disney Plus with its package is slightly cheaper. I don't know. I've always been skeptical. I'm probably not the right person to knock that. I constantly knock Netflix. I just don't get it. I never liked the previous CEO. I thought he was too brash. The stock hasn't gone anywhere in 5 years. Isn't this a favor to Kathy Wood too? I mean, maybe that doesn't help it. I mean, it's just, I don't know, you can ask Tuttle, he'll tell you. But anyway, it's just this is a seasonally weak period. I think that's what it comes down to. On Bloomberg showed a chart, and I was kind of amazed by it. Their subs are basically flat at this time of year every time, and that is weird because winter is usually cold. You think people would be watching streaming more, or maybe 2020 pushed everything so forward. I don't know, but investors are looking for a positive report. And I think that if they miss, it's going to upset the apple cart big time for them.
Now, listen, last little bit on this, but I think if they've got subs that are still flat, considering what's happening with the economy, I think that'd be a good result for them.
It could be, yeah, but the way the trend looks, it would be negative based on the chart. I don't know.
All right, let's move on to the next one. Goldman Sachs, and they report Tuesday pre-market. Big bank numbers were a success on Friday, but what can Goldman bring to the party? Earnings are expected to be down 24% year on year, and EPS has been dropping each quarter since 2021. Consensus EPS is $8.14, but the earnings whisper number is a lot lower. It's $7.97. Maybe investors could be looking for a surprise to the upside with short interest 21.6% lower than its last earnings release. Brendan, could we see Goldman surprise to the upside?
So the S&P is up this quarter. Rate traded, the bond market has been fully volatile. Those are both wheelhouse items of Goldman Sachs. Those are things that they make money on typically. And the market the analysts are sandbagging this big time. Like, consensus is very negative. They're looking for a fall in EPS, like you said, revenue lower by 1%, fixed income trading down 11%. I don't get that one. I mean, I know that might incorporate new issues that could factor in maybe. Equities trading by lower by 12%. I mean, trading, yes. What about the fee revenue? Because people, if the S&P is up 200 and something points, which is like 5%, if you have fee-based revenue, that's 5% higher in fees just by simple math. So, I mean, I think they're putting a lot of context into investment banking, which is down almost 30%. And I think that's what they're all expecting. I think there will be an upside on fixed income trading and equities trading to some extent. It's I think they're going to surprise on that end. There's such a big focus though on expenses and like this and that, and nobody likes the CEO anymore. They think he's weak or something because he keeps pivoting. I would just say the stock has had a nice run that got over the 65 weeks since the problems to start the month. I wouldn't be surprised if they saw inflows because, for example, when the banks were going down, they saw a lot of deposits go out the door. And we'll talk about Ozark and is it Ozark? OZK? I don't know what the name of the bank is, but we'll talk about this later. But a lot of these banks lost deposits because they're not giving anything on the checking. They're not giving anything on the savings rate. Like you can go to a money market and get almost 5%, but the bank is giving you 2 or 3 on a CD. That's not competitive. So Goldman Sachs, JP Morgan and Bank, the other banks last week saw deposit inflows. I bet you Goldman sees a gain in assets as well, simply based on the fact that they can get you more money on your cash, and the banks are behind this trend. And I think the brokers has Morgan reported yet? Is that next week?
That's this week.
Yeah, Morgan's gonna probably have an upside as well because of fees, and they're gonna take in revenue. They're gonna be like, all right, banks, you're not gonna pay anything out to your investors. We will. And that was an old push that we used to do back at Morgan Stanley. We would say, well, you know what, you can do more than at Morgan Stanley, that we can do your banking for you. But not only will your cash not sit here and earn dust, but you'll put it into something earning interest. The banks have missed the boat on this. And I think Goldman Sachs, Morgan Stanley, I think the brokers are going to benefit dramatically in this. Goldman's stock price has done well the last 3 weeks. It got over the 65 week. I know Breath is not supportive, so that could impact things. But I think this is a surprise possibly in this number. Stock's trading better. Consensus is just so very negative. I mean, if they miss, there's something wrong with Goldman Sachs. That will probably end Solomon's job there if they miss. I don't think he'll last because things are working in their favor. Investment banking isn't, but that's just the nature of the economy. That's already known. Everybody already knows investment banking stinks right now. And I think that if there's an upside, I think fixed income trading won't be down 11%. And I bet you equities trading will be better than expected too. So those are two variables that nobody's taking interest in. It's kind of fascinating.
Yeah, maybe the CEO will be able to put a positive spin on it.
Yeah, it's possible. Is he still a DJ? I don't even know.
Oh, yeah. All right, let's move on to Taiwan Semi, and they report Thursday pre-market. Consensus EPS of $1.21. And this is another name where we see a big drop in short interest since its last earnings release, down 44.8% since then. But I would argue that the bigger news since its last earnings release was Warren Buffett selling his stake. Warren was on CNBC last week, and when asked about selling his stake and thoughts on China and Taiwan, his answer was, let's say, less than compelling. You should go check out Quiver Quantitative and their video on that sort of side, but I was watching that last week. It's very interesting. I'm not sure how investors play China-Taiwan tensions, Brendan, but what do you think we can see from these numbers?
So the way the stock is behaving, it looks like semi-demand. Semiconductor stocks are very good proxies for demand in general. I've always thought that. Taiwan Semi topped in early January. I think that was we saw a nice run in demand within the economic numbers. This China-Taiwan story in the U.S., I think it's a smokescreen for the lack of anything going on here in our U.S. politics. And I think they're just trying to, make a nuisance of. Let's put the story over there. If it's not China, Taiwan, it's Ukraine. It's as for Warren, he looks really old. That was what stuck. I haven't seen Warren Buffett on television in a long time. It really stuck out to me. He looks really old. I know he's what 90 something now. But I don't know. I mean, does it matter what he's really saying anymore? I don't know. Because his younger groups are running the show, like the younger guys he put in charge are running the show there, and taking different risks. And the sell in Taiwan semi actually was timely because the stock hasn't gone back there. Fascinating enough, but I don't think he made that call. That's why he was sort of like less than compelling. I don't think he was. I don't think it's his show anymore. But and Warren Buffett's been a legend and all that. But I mean, it's Ian Munger. Like, my God, I don't know how they're just pretty old people now, pretty old investors. I think the U.S. side with the smokescreen of fighting with Taiwan, not Taiwan fighting with them, but going over there and irritating China. It's just one big smokescreen for control. TSM, on the other hand, big player, high margins, lots of clout. They're getting into AI and a big deal. AI, I think, is a real. Everybody's scared of AI. I think AI is a great thing that I'm openly looking to use, actually, for that matter, because I mean the human brain only works in so fast speeds. Throw an AI on there, have them have things look at your information better. You're going to benefit, and I think the world is coming to that solution, and TSM is a leader in it. Their chips are big in it. Bloomberg's calling it a secular story. You don't really see that often, where an analyst calls out a secular story in a quiet environment such as we are. They're also diversifying production to other countries. That was a request, I think, probably from the U.S. to get away from China to some extent. I think they're coming here, United States, if I'm not mistaken. I could be wrong. The chart, though, does argue that they could say, all right, AI strong, earnings are good, margins held in, but yeah, we're seeing a slowdown. And I bet you that's sort of how it's going to play out. The stock is telling us that there is a slowdown in semis at the moment. I think traders are a little concerned about the report, and they're paring back as a result. Buffett whether Buffett made the call or not, they made a good call so far in selling the stock back then. And I think that they saw stuff within their portfolio that argues demand is slowing for semis. And I think Taiwan Semi may tell us that.
Okay. And the last one we're going to dig a little bit deeper into, Brendan, it's in the regional banks. And it's going to be an interesting week for them, with several of them reporting. Now, Bank OZK, you'll see the affiliation because Bank Ozark, what was one of the best shows on Netflix last year?
Ozark.
There we go. All right, Bank OZK is one I want to look into. And if you don't know who they are, they have more than 70 locations through Georgia. They report Thursday after the close. They're expected to report an EPS of $1.43 and revenues of $364.1 million. The share price looks similar to a lot of the other regional banks, and it's down nearly 16% this year, which is not bad compared to some of the other names. Brendan, they recently increased their dividend to 35 cents. So maybe things are better than investors think.
So again, going back to my general view of the banks, I think that they are missing the boat in some cases. They're not paying. So everybody's been talking about this. Deposits are way down the bank system, like tremendous drop, which is probably why the Fed is keeping money up to offset that drain. Staying in the system, it's just going elsewhere. Well, Bank Ozark, they raised the dividend, but do you think they raised the deposit interest rate payable to their people, their depositors? I doubt it, and I think that's the problem. They're missing the. These banks need to pay they need the cash to lend. If the deposits go out the door, they lend less. If they lend less, they make less money. Then they can't pay the dividend. Conversely, if you keep the depositors in-house, you can lend more, earn higher interest rates, and your investors will be like, all right, you're earning more income instead of sending it out the door via dividends. I think this is a problem for a lot of the regional banks. I think they have too much exposure to CRE. One of the biggest stories with these guys is that this past quarter, almost 20% of their loans were CRE loans. Well, commercial real estate is not in the best shape right now. That was a big story over the weekend. Like we have a little internal chat. We use a column E, where I track stories that are on, everybody's talking about. It's like a sentiment, my own little sentiment thing. And someday I'll run the AI engine on that, just like everybody's doing these days with sentiment. But it's all real estate, all commercial real estate. How much? Like I think the national vacancy rate is up to 19% now or 18%. Well, we have one of my advisors, very smart guy in real estate. He said 70% is break even. So we're getting very close to break even on a lot of these properties. 17, 18%. It doesn't mean it's going to spike, but these smaller banks are going to feel the stress because guess what? They probably have the more risky of the loans in some cases because they have to take more risk compared to these larger banks, which can diversify some of that CRE risk off. So for Ozark, the numbers, the stock broke support a couple of weeks ago, like every bank for the reason, but it hasn't been able to regain any support. Like Goldman Sachs stock has bounced off support after its dive. It came back. Bank of America, I think, is the same way, and I forget. We're talking about that next, but I would just say investors are not optimistic. It looks like going into this report. I think the dividend payout is a waste of time if they don't start raising interest to payable depositors. They need to keep the capital, not lose it, and I think that's going to be an ongoing theme for these banks. That if they keep not paying out their depositors, they're going to lose assets. And you can't, if you lose assets, you can't lend. And if you can't lend, you can't make money. I mean, you can go buy product if you want with your cash, but that doesn't work. So it's just, this will be an interesting story. This is a really regional bank. I wonder if they have Florida exposure. It'd be intriguing to find out if they do. I don't know if they do, but it says 70 locations in Georgia. But if they had exposure elsewhere, it'd be interesting to hear what they have to report. Also, the CRE thing, it may not come up. It showed up in one of the analyst reports, so somebody's bound to ask it, given the threats to CRE.
Yeah, we did a video last week with David Auerbach from Armada ETFs. You should go check that out. We spoke about the commercial real estate, the differences between different companies on that sort of side of it, and how they manage it, and so forth. So, make sure for the viewers, make sure you go check that video out. It's actually been very popular already. I think we only published it on Friday.
Yeah, it's a big no. I saw that actually on one of the posts. It's a big commercial real estate is a major variable that so far a lot of the players have handled it very well, but you're seeing select instances where they're having it like Blackstone, I think defaulted on 2 or 3 loans, if I'm not mistaken. Payments on those loans, like one place in the UK, another place in Boston, if I'm not mistaken, and a couple others. Plus they have BREIT, which hasn't been a fun story for them either. These regional banks will bear the brunt of that. They take more risky exposure. The charts all show it, and Ozark will be an interesting read on that because they have this 16 to 20% exposure. I mean, we got to lend to somebody, right? And if nobody's buying homes, they're probably buying homes down there because it seems like prices in the South are getting more expensive for home residential than they were in the past.
Yeah, definitely. All right, let's move on to love it, like it, leave it. And once again, we're sticking with this earnings theme with so many great companies reporting this week. Let's start with Bank of America, and they report Tuesday pre-market.
So I like it. I pretty much thought that was the case. It climbed through resistance of the range, but it appears to be at a location where the shorts have hit it at before. So it needs to keep growing, or if it might attract some shorts, but I like it.
IBKR's Interactive Brokers, and they report Tuesday after the close.
It bounced off a 20-week recently, and it's bouncing higher. Trading exposure, crypto, that's in their wheelhouse. Crypto trading has been big.
ASML, they report Wednesday pre-market.
So I said TSM was a week, possibly a week warning coming. ASML, I think, might be the same thing. Chart's saying leave it. It ran to resistance a few weeks ago and has not reclaimed that high. So the semis as a whole are telling us there's something going on there.
Okay. And IBM report Wednesday after the close.
I've liked IBM for a while, but I'm back to leave it. This is where if you want a short technology, you buy IBM. That's what I heard. I think somebody say one time. I don't know if that's true anymore because the new CEO has done a good job. But I would leave it. Ran to the 65-week, moved lower last week, even with the markets higher.
Okay. AA Alcoa Wednesday after the close.
Very interesting read on metals demand. Metals are falling in price unless you're gold or silver. I would leave it. Same thing, bounced last week, but did not reclaim the selling high from the previous week. So it seems to be a Dow stocks theme. The Dow stocks are, is Alcoa still part of the Dow? I think it is.
I'm not sure.
I don't know. Anyway, it's a Dow-like stock, or it used to be. Same thing though. The previous week it fell. This past week it bounced, but didn't bounce enough, so I'd leave it.
Okay, and the last one, AXP, American Express. They report Thursday pre-market.
I like it. I bounced off the 65 week and then went through the 20 week to the upside. And they should have a good read as well, because they're not benefiting from 25% interest rates because everybody pays off their credit card with them, but it makes them a better credit play.
Brendan, thank you so much. Some great stocks we've covered this week, some great insights. You have a fantastic week.
Hey, you too. Take it easy.
And for everyone else out there, good luck investing.